If you've ever wondered why some traders make money consistently while others keep losing, even with good strategies, the answer is often not what they trade, but when they trade. Timing in the stock market is not just important, it's everything. You can have the best setup, the perfect indicators in the strongest stock, but if you trade at the wrong time of day, your chances of success drop dramatically. That's why understanding the best time to trade the stock market in EST is one of the most powerful advantages you can give yourself as a trader. The U.S. stock market officially operates on Eastern Standard Time, and most of the world follows this timing when trading American stocks. The main session for the New York Stock Exchange and NASDAQ runs from 9:30 a.m. to 4 p.m. EST. But here's the truth most beginners don't realize. Not all hours inside this session are equal. Some hours are full of opportunity, high volume, and strong price movements, while other hours are slow, random, and dangerous for retail traders. Professional traders don't sit in front of the screen all day. They focus on specific time windows where the market is most active and predictable. These windows are when institutions, hedge funds, banks, and large investors place their biggest orders. When big money enters the market, volatility increases, liquidity improves, and clean trends form. This is exactly what traders need to find high probability setups. Another critical reason why timing matters is because different types of traders are active at different times. At certain hours, you'll see day traders dominating the market. At other times, it's long-term investors adjusting positions. And during some periods, algorithmic trading bots control most of the price action. If you don't know who you're trading against at a specific time, you're basically gambling instead of trading. Most retail traders lose because they trade during low-volume hours when the market has no real direction. Prices move slowly, spreads become wider, fake breakouts happen, and stop losses get hit easily. This leads to frustration, overtrading, and emotional decisions. On the other hand, when you trade during high volume hours, the market becomes more transparent. Trends are clearer, support and resistance levels work better, and your technical analysis becomes more reliable. So in this video, you're going to learn exactly which hours in EST are the best to trade, which hours you should avoid completely, and how different trading styles like day trading, scalping, and swing trading depend heavily on time. By the end, you'll not only know the best time to trade the U.S. stock market, but you'll also understand how to build your entire trading routine around time, just like professional traders do. The first and most important time window in the U.S. stock market is the market open from 9:30 a.m. to around 11 a.m. EST. This period is widely considered the best time to trade for most day traders, and there's a simple reason for that. This is when the highest volume and volatility of the entire day happens. Overnight news, earnings reports, economic data, and global market movements all get priced into stocks at this exact moment. When the market opens, millions of orders hit the market at the same time. Institutions adjust positions, retail traders rush in, and algorithmic systems start executing large strategies. This creates strong price movements, fast momentum, and clear trends. You'll often see stocks making their biggest moves of the day within the first 30 to 90 minutes after the opening bell. This is also the best time for momentum trading. Stocks that gap up or gap down in pre-market usually continue moving in the same direction after the open. These are called gap and go setups, and they are one of the most popular strategies used by professional day traders. Because volume is extremely high, entries and exits are easier, spreads are tighter, and slippage is minimal compared to other times of the day. However, this period is not beginner-friendly. The same volatility that creates opportunity also creates risk. Prices can move very fast, fake breakouts can happen, and emotions can take over quickly. If you don't have a clear plan, strict risk management, and discipline, you can lose money just as fast as you make it. That's why professional traders prepare all their trades before the market opens, using pre-market analysis instead of reacting emotionally during live price action. Another important point about the opening session is that it sets the tone for the entire day. If the market opens strong with heavy buying, it often leads to a bullish day. If it opens weak with strong selling pressure, the rest of the session usually follows the same direction. Smart traders use the first hour not just to trade, but also to read the overall market sentiment. In short, if you could only trade one time window in the entire day, the market open would be the best choice. It offers the most opportunities, the cleanest price action, and the highest probability setups, but it also demands the highest level of focus, speed, and discipline discipline, which is why many successful traders make most of their daily profit within this single time period and then stop trading for the rest of the day.
After the excitement of the market open fades, the stock market usually enters what traders call the midday session, roughly from 11 a.m. to 2 p.m. EST. This period is often known as the dead zone or lunch hours because trading activity slows down significantly. Volume drops, volatility decreases, and price movements become smaller and more unpredictable. The main reason this happens is simple. Most institutional traders and big players step away during this time. Hedge funds, banks, and professional desks have already executed their major orders in the morning. Many traders take lunch breaks, and the market is left mostly in the hands of retail traders in algorithms that focus on small, short-term moves. During the midday session, you'll often see stocks moving sideways in tight ranges. Breakouts fail more often, trends lose momentum, and fake signals become very common. This is the worst time for beginners because the market gives mixed messages. Indicators stop working properly, support and resistance levels break randomly, and trades feel more like guessing than strategy. For scalpers, this session can still offer some opportunities, but only for very experienced traders. Scalping during the midday requires extreme patience, quick decision-making, and very tight stop losses. Profits are usually smaller, and the risk-to-reward ratio is not ideal compared to the morning session. For most day traders, the best decision during this time is to do nothing. Professional traders often use this period to review their morning trades, journal their performance, analyze charts, and plan for the next session. Not trading is also a skill, and avoiding bad market conditions is one of the biggest secrets to long-term profitability. This is also the time when emotional overtrading happens the most. Traders who missed good setups in the morning try to force trades just to make money. This leads to low-quality entries, revenge trading, and unnecessary losses. In reality, the midday session is designed to test your discipline more than your strategy. So if your goal is consistent profits, the midday session should mostly be treated as a break, not an opportunity. Unless you are a highly experienced scalper, staying out of the market between 11 a.m. and 2 p.m. EST will protect your capital and your mindset, which is far more important than trying to catch small random moves. As the day approaches its end, the stock market enters the final session from 2 p.m. to 4 p.m. EST, commonly referred to as the power hour. This is the second most important time window after the market open, and for good reason. Volatility increases again, liquidity improves, and major price moves often happen as traders finalize their positions before the close. During this session, institutional traders, hedge funds, and mutual funds adjust or close positions to meet daily targets. Retail traders also jump in, either to capture last-minute profits or to exit losing positions. This combination of forces creates high-volume trading, rapid price swings, and clear directional trends, similar to what happens during the morning session, but with slightly different characteristics. Power hour is ideal for momentum trading, swing trades, and even day traders looking for late entries. Stocks that struggle to move earlier in the day may finally break out as the volume spikes. Additionally, many traders use this session to scalp quick moves because bid-ask spreads tighten, making entries and exits faster and more precise. However, the final hour has its own challenges. The volatility can be unpredictable because traders rush to cover positions, causing sudden spikes or reversals. You may see wild swings in a single stock within minutes. Without proper risk management, a single trade can erase your profits from the entire day. That's why professionals often focus on stocks with clear momentum and avoid forcing trades on low volume or stagnant securities. Another key aspect of the market close is the importance of reading market sentiment. Closing prices are used to evaluate daily performance, calculate technical levels, and even influence the next day's pre-market activity. Traders who understand how to interpret these closing movements gain an edge because they can anticipate how stocks are likely to open the next morning. In essence, the last 2 hours of the market offer some of the best trading opportunities of the day, but only for traders who remain disciplined, focused, and prepared. While morning trades are about capturing fresh trends, afternoon trades are about exploiting volatility before the market shuts down, allowing you to maximize gains or protect yourself from unexpected reversals. While most traders focus on the regular session from 9:30 a.m. to 4 p.m. EST, the market technically never sleeps. Pre-market trading occurs from 4 a.m.
p.m. to 9:30 a.m. EST, and after-hours trading runs from 4 p.m. to 8 p.m. EST. Both of these sessions offer opportunities, but they are very different from the regular market hours and come with unique risks. Pre-market trading is driven largely by news events, earnings reports, and global market reactions that happen while the U.S. market is closed. During this time, liquidity is low, meaning there are fewer buyers and sellers, and spreads between the bid and ask prices are wider. Stocks can jump or drop dramatically on just a few trades, creating big opportunities for early birds, but also higher risk of getting caught in false moves. Only experienced traders with a solid understanding of pre-market patterns should trade at this time. After-hours trading is similar. Big institutions may release earnings, adjust positions, or react to economic data after the market closes, causing volatility. However, like the pre-market session, liquidity is low, price movements can be exaggerated, and technical signals that work during regular hours often fail. For most retail traders, after-hours trading should be approached cautiously, with strict risk management and smaller position sizes. So, what does this mean for you as a trader? The truth is, there is no single perfect time that works for everyone. Your best trading window depends on your style, experience, and personal schedule. Day traders benefit most from the market open and the power hour, when trends are strongest and setups are clear. Scalpers may focus on morning and late afternoon to take advantage of volatility spikes. Swing traders, who hold positions for days or weeks, may be less concerned with exact timing, but still use high volume periods to enter or exit trades efficiently. The key takeaway is this: understanding the behavior of the market at different times gives you a strategic edge. By avoiding low volume periods, respecting high volatility windows, and aligning your trades with the natural rhythm of the market, you can improve your accuracy, protect your capital, and increase your chances of consistent profits. Timing is not just a detail, it's a core part of trading mastery, and those who respect it will always have an advantage over those who trade blindly. If you follow this timing strategy, prepare before the market opens, focus during high volume periods, and stay disciplined during slow hours, you can transform the way you trade. Mastering the when is just as important as mastering the what, and it's one of the simplest yet most powerful ways to level up your trading game. Now that you understand the different trading sessions, it's time to tie everything together with practical tips that can make a real difference in your results. First, always plan your trades before the market opens. The morning session is fast and volatile, and reacting in real time without preparation is a recipe for mistakes. Analyze pre-market movers, identify key support and resistance levels, and set your entry and exit points in advance. Professional traders do this every day because it reduces stress and improves decision-making under pressure. Second, manage your risk according to the time of day. The first hour and the last hour of trading are full of opportunity, but also high risk. Use smaller position sizes if you're new, and always stick to stop-loss levels that protect your capital. Remember, preserving your trading account is more important than chasing every potential trade. A single mistake in a high volatility period can wipe out several profitable trades from earlier. Third, respect the midday slowdown. Many traders feel tempted to force trades during this low volume period, but the truth is, the market is almost random during these hours. Use this time to review your morning trades, journal your performance, and refine your strategy. Avoiding bad trades is just as important as finding good ones, and skipping low probability setups can dramatically improve your long-term results. Fourth, leverage the power hour strategically. The last 2 hours of the session are perfect for capturing strong momentum and late trends, but you must stay disciplined. Focus on stocks with clear patterns, watch volume closely, and be ready to exit quickly if momentum fades. Many professional traders rely heavily on this session because it provides clear signals, but only when approached methodically. Finally, align your trading window with your personal style and lifestyle. If you're a day trader, prioritize the first and last hours. If you're a swing trader, focus on entering and exiting during high volume periods, but don't worry about the exact timing during the day. And if you trade pre-market or after hours, do so cautiously with strict risk controls and awareness of lower liquidity and wider spreads. In conclusion, mastering the best time to trade is about more than just knowing the hours. It's about understanding market behavior, recognizing when opportunities are high probability, avoiding periods of chaos, and developing a routine that fits your style. Traders who internalize these principles consistently outperform those who ignore timing. Time is the silent edge in trading. Respect expect it, plan around it, and you'll see how it transforms your results over weeks, months, and years.